Everybody, Jared Jones, great news. Inflation came down. The CPI is at 6.5. The war is won. I want to see Jerome Powell with a mission accomplished banner behind him on his next press conference. The reality is, folks, it's far from over. And if you look at the reality of the world, in December, there was many reports from different government offices that were reporting on things like the amount of debt people are racking up in order to get by. People are still maxing out credit cards in order to live. And all of this is in the same time period of when we're saying that inflation has come down from plus 8% to now in the mid 6%, which again, any dent in inflation is good news. I'm not trying to say that it isn't, but I am also saying most of us kind of look at each other and say, where is this coming from? Do you feel it changing? And you can still hear the stories of people going and buying 2 bags of groceries for $100. But the reality is, when you see these news reports that also came out on statistics for consumers over this past 30 days, you can still see we're in a lot of trouble. And the only thing really stemming recession, how we haven't had a massive financial collapse so far, is purely because people are just borrowing it, So we have a recession being staved off to the degree that people can actually afford to put things on their credit card. The other thing too, you have savings being eroded. I think I saw a statistic that came out last month as well. 42% of Americans have less than $1,000 in savings. This is a huge record trough bottom, if you will, on how much money people have in the bank, and that's not good. So you look at all this, savings indication that people are just running out of cash. That means at the end of the month, when they bring all their wages in, they pay their taxes, they've got nothing left. And when those percentages are falling, you got a lot of problems, not just for consumers, but you got it for the banks, So banks need money. They don't keep it in the vault, They're using it to make money off of and create arbitrage off of your dollars. Well, they don't have it. Lending changes, patterns of available credit changes. You're going to have, I'm telling you, there's no reason in the year 2023 we can't have some crazy issues in the banking and financial sector that were experienced in 2008, okay? Because people are just going bust, and you kind of back all that up with where we're heading next. And I kind of want to shed some light on some of the predictions that came out recently through Fortune.com. Actually did a fantastic job of combining all of the headliners. And I'm going to summarize some of that for you. When you look across the folks that are really entrenched in the industry, when I say entrenched in the industry, making money off of houses selling, they were not very... They tried to stay away from being bearish or bullish. They would say things like, you had Realtor.com and National Association of Realtors all come in and say, hey, we think you're going to see a flat market. They would say it's going to be 0 or it's going to be 1%. Zillow did the same thing. Realtor.com was actually the worst prediction when you look at the backdrop of all the economists. There's over 20 of them kind of working together on this. Realtor.com actually predicted a 5.5% increase in 2023. And when you go to Wall Street, you have Wall Street, Amherst Residential, these are large owners of residential houses that were bought up over the last few years and converted into rental property. I mean, these people are saying, we're going to lose 5-10% in the year ahead. And additional to that, if we see recession entrench in, we're going to see maybe 20%, and some predictions were above 20% or 20-25%. You got to understand, folks, we're not very far away from that. Some of the data that we had last year was from Case-Shiller Index. They actually came out, in October was their most recent report. They're the ones that actually, one of the most widely shown graphs where you saw the peak hit around May of last year rather, and then all of a sudden it tips over, and they reported, hey, we've lost almost 3% between June and October of this year, and that was in 2022. So Case-Shiller's data is now old, right? Because we're now in January. That data is October. I believe the next time you see Case-Shiller come out and push their next results, you're going to see more loss. The velocity of the loss they reported, okay, when they said, hey, we lost 2.4%, in the span of time between June and October, that represented the second largest loss of price on the Case-Shiller index ever reported since World War II. Okay, now you gotta understand this. We had a price loss of 26% when you look at the crash that happened in 2008, and particularly it went from a span of 2007 to 2012. 2007 to 2012, the last economy for housing, it was a 26% peak to trough loss, okay? If you look at pricing on a graph, you will see that we had around 120 consecutive months of vertical price growth this time around, okay? Things went historically ridiculous, okay? And so you're going to have a lot of problems. The reality too is a lot of folks are believing the Fed's coming out of this and they're going to back off and they're going to pivot. The Fed doesn't have anywhere to pivot. The Fed can see the data that people have no savings, they have no credit. If the Fed even left the interest rates where they are, inflation would still not correct enough to save the poor and the middle class. They would literally break the economy. The Fed is a proverbial back against the wall. They don't have an outlet to move away from in terms of these interest rates, which means their only position is to keep pushing them up. Just before the 6.5% CPI, the most recent Fed update before that, which I think was around a week earlier, end of December, turn of January, the Fed freaked the markets out. And you know why the markets were freaked out? Because they said the same thing they've been saying the whole time. Jerome Powell's like, there's no plan. There's no plan to change. There's no plan to take our foot off the gas of accelerating interest rates. And the reality is the Fed knows that, yeah, the markets are going to be damaged, but there's only one way that they can deal with the situation, and that is by dealing with raising the interest rates even further, okay? So with all that being said, we're going to see what happens this year, but I honestly think that you're already seeing interesting things. Wells Fargo announced 2 days ago that they're going to stop writing mortgages unless you are wealthy, a wealthy Wells Fargo investor that already invests with them, that they're managing your money, or if you're a minority. So sorry, if you're poor or white or non-minority of any shade, you do not get a loan. What a bunch of crock that is, right? It's funny, like, how is that not, it's got a hint of racism in that particular plan. And again, this Bank of America did something similar. They had one of their VPs announce something like, we're going to focus on helping the minorities out. We're going to, fund more loans in that direction. Wells Fargo's making that same mistake. It's sad. It's really sad when we're just still in this mold. It's like, hey, favoring people by the color of their skin didn't work before. It wasn't a good plan. Let's try it again. And Wells Fargo particularly has a history of not caring for that community anyways. So it's like, that's such a bizarre thing. And I don't want to get carried away on this video. But that's the backdrop, man. That's the market right now. Got some more updates coming this week. I couldn't fit them all in here, but some interesting things happen in the market. I want to hear your thoughts below. What do you think's happening in 2023? Who's right, who's wrong? And where's it going to land? Also, give this video a like. YouTube has buried my absence, being gone off this platform for a while. It's burying my videos, so I appreciate all the loyal that watch. Give it a thumbs up, help me out. We'll see you guys on the next one. Take care.